the Brantford Exchange. Today, we're going to be getting into the second video ever, and we're going to be starting to break down basically the first little tad bits of technical analysis and the way we trade. Um, we are going to first start off by talking about how we normally find our stocks, though, the stocks that we trade. And it's really not, it's not that hard. I mean, you use the internet, you can look on different websites, you can look on stuff like, I mean, not that you want to take everything that you see, you want to take it with a grain of salt. So, I mean, you can look on things like MarketWatch, you can look on Yahoo Finance. Preferably, though, I think that the best places to find good stocks to trade is within actual communities of people online, mostly like social media and stuff like that.
Just something that you want to stay away from is like, I don't know if any of you guys have been in a stock twist group chat or whatever. Those are just a lot of people, they're stuck in a stock that it might not be doing so well, so they want to just pump it up. Like, it's called a pump and dump. The volume, they keep putting money in to raise the volume, the stock price goes up, and then once they make their money, they're out, and everybody else that's in there is just, they lose their money.
And that's what you got to be careful about when you go online on websites, like even like MarketWatch and even like Yahoo Finance, because you'll see a lot of nonsense, like those ads on the side that are like, oh, like top 10 stocks for 2018, stuff like that. You can look at those stocks. I mean, you can always, this is what technical analysis is for, though.
Yeah.
I mean, you can go online, you can find tickers to look at. It's just important that you're going to do your own due diligence, which basically just means that you as a person, separate from the opinion of others, you have to be able to decide, you have to determine the value of what you're buying.
And like that's what we're, that's our main goal. That's what we want to teach you guys, is how to see a true valuable stock. Whereas there's a whole bunch of garbage out there. We're going to teach you guys how to pick out the good ones.
Right.
And, but that's, I was talking about the stock twist chat, that we want to make a genuine community of people that are able to just share their opinions, shout out a stock, give a good reason why they shouted it out, not just, saying tickers and not giving any reasons.
Right.
Which will, what we're going to go over today is how we break it down, how you could find good stocks.
Right, how you determine the potential in the stock.
Exactly.
And there definitely is, I think it's important to note too, there is a big difference between market value and intrinsic value. So what we mean by, determining the true value of a stock, because the price, the market price of the stock does not necessarily accurately reflect the true value of that stock. I mean, obviously, you want to buy a stock at a more accurate price, closer to, you want the market value to be closer to its true intrinsic value of the company or of the underlying asset.
Yeah. So the first thing that we want to go over is us being young. We understand just from experience, like how we trade. We want to, people don't want to wait to see their profits. Like, investing isn't hard. It's easy to put your money into a big stock, like say Amazon, and you just wait over a couple of years and you make your money that way, which is perfectly fine. There's no problem in that. But how we trade, the markets have pullbacks. Like, it's experiencing one now. It's a very volatile market. So how we trade is like short to midterm, day trade, swing trade. That's pretty much.
I mean, me personally, I don't normally trade for more than a week. I'm not usually in a position for more than a week, and even in that short amount of time, whether it be one day if it's a day trade, or maybe 2 or 3 days, you can still cover decent profit by finding the right stocks. And I mean, by decent profit, I mean it's really not hard to cover anywhere in between 5 and 10% in 2 or 3 days. I mean, that's pretty common.
If you set a goal for yourself and you cover 5% a week, you're doing great. Like, that is a good goal. 5% a week, at minimum, you're doing fine. Like, you're making good money, or you're making a good return on your portfolio value. The dollar amount, you guys don't really need to worry about that all that much. It's all about percent gain on your account. So, how we do that, one of the big things that we like to follow are stocks that move quickly, not too quickly. Like, there's it's called nano caps, which is like, I think it's 50 million and below.
I think it's 50 million.
So, you don't want to be trading that because the volume is going to be very low. So that's why we trade small to large cap stocks.
Small to mid.
Small to mid.
Yeah.
So
and that would be small. I think small cap starts at $300 million would be the market cap. That's where small starts, and it goes up to the cap, or the top of mid cap is 10 billion. a 10 billion market cap. So anywhere in between 300 million and 10 billion is the market cap that we like to look for.
Right. Yeah. So, and then another thing is the ETFs. We really like to trade ETFs. They move quick. They are just really easy patterns to follow. And each ETF that we trade, it has an inverse ETF. So if one's up, the other one's going to be down. If the other one's down, the other one's up. So
which allows you to rinse and repeat the same process. It's really super, super simple. I mean, as soon as you guys can get this down and understand basically just how we trade, you're golden. I mean, you're able to rinse and repeat the process.
Yeah, if the whole market's down. So say you trade Apple, Amazon, Home Depot, for example. If the whole market's down, these stocks are also going to be down. So you're going to be sitting there looking for a stock to trade, and because you want a stock that's uptrending. This is not an example of an uptrending stock, as you can see. It's like very simple, downtrending stock. Is it? It could be potentially be a good buy if you want to look at it, look at the indicators. But as far as you looking for a green stock, these ETFs one of them will always offer you. It'll be green.
Right.
It's just a matter of picking which one, identifying the patterns, coming up with a plan, and executing it.
Yeah, and the ETFs, it's important to note, so like this right here, like you said, this is an example. This is Home Depot. This is an example of a downtrending stock, but it's also a company. I mean, obviously, Home Depot is a company. I mean, I'm sure you've been there at some point in your life, but the ETFs, mostly, they monitor things like commodities. We like to trade commodity ETFs. I'm sorry. Things like they basically track the price of things like natural gas, crude oil, gold, silver, things. Commodities.
Right. So if you type in like JNUG, JNUG is a ETF. And when we say ETF, like you don't trade it any differently than you trade a stock. It's almost identical to a stock. Like you trade it the same way that you normally do.
Yeah, so this is JNUG. I mean, this is one of the gold ETFs, and JNUG is the one. So basically, like how we said, there's one for bullish. This would be the one that's bullish on gold.
And it'll tell you at the top, too.
And it does tell you up top. If you look up, right there, it says
bull times 3.
So bull 3 times ETF. And then if you look, the inverse of JNUG would be JDST. And I'm sorry, no, not JDST. That would be what is it?
No, it's JDST.
JDST. Oh yeah. So as you can see, it basically is the exact inverse of JNUG. So look at this, and then I'm gonna type JNUG back in. Oops. JNUG back in, and it's the exact opposite.
Yeah. If you look at it just from today, you can see it has a big red candlestick, and then if you go back to JDST, you can see that it has a big green candlestick. It's literally it's a mirror image, just opposite.
So it's just a matter of being able to determine which one is going to be the right one that day, being able to run that technical analysis. And then after you figure that out, you can rinse and repeat. You can get in JNUG at the right time. You ride that up for say 5%, and then you get out. You take your profits, and then you wait on JNUG to do the same thing. And you wait for a good entry and your exit, and you can rinse and repeat that process.
Right. So, we're just gonna run through, now that we talked about what kind of stocks we like to trade. We're gonna run through exactly how we do our analysis. So first, if you want to pull up Apple, so we were looking for stocks. The time frame that we use, you want to look at it at the 4-hour, 180-day time frame, because that gives you the best overall direction of where the stock is going. If you look at it. The 1 minute, 1 day, that's only gonna
show you.
Yeah, that's only gonna tell you where it is for that day.
Right.
So seeing this, I'm like, okay, well, potentially, it's really consolidating here at the end. It could potentially shoot up, but I don't know where it's going to go in the whole picture. I don't know what it did yesterday.
You don't know what it looks like in reference to its history, which is pretty important because stocks, at least the way we trade, it's all about pattern, basically. It's all about being able to identify pattern and being able to use indicators to determine the direction of the stock price in the future.
Yeah, and we're just covering all this, just the main points. There's going to be separate videos for each and every one of them.
Oh, yeah, if you guys don't understand some of the stuff that we're saying, this is literally just an overview of how we trade, and in the future, obviously, we're going to break down each of these individual topics and make sure that you guys fully understand each little term and definition, and we'll go from there.
Yeah, that's what we really want to stress. We're really big on breaking it down, very simple for you guys. We're gonna make it.
5-year-old could
That's
understand it.
it. Really, yeah, it's gonna be very easy. So the next thing that we look for is after you establish that it's uptrending, you establish it how it's uptrending by drawing support and resistance lines, which we will go over.
Support and resistance. If you guys see these red lines right here, those are our support
Peaks
and
and
resistance
valleys.
line.
Yeah, it's
Yes,
peaks and
exactly.
valleys.
It's where the stock, where does the stock peak out at, which in this case was, right here, and where does it bottom out at, and where does it start to uptrend again? That'd be right here, right here, right here, right up here.
Yeah, it's very simple. You can go in depth. This is just an overview. And then the next thing that you want to look for is, like we said before, is the volume. You don't want to trade a stock that has no volume, because if it has such little volume, it's easily manipulated.
Yes.
You could put a sell order in, and it might not get executed. And someone that has a big share in that small company sells all their stuff. You're going to be sitting there just watching it go down, and your order won't be filled.
Because, buying and selling stock, when you buy and sell stock, you're not buying and selling the robots. You can't buy and sell whenever you feel like it, unless you find a stock with good volume.
Right.
Because there has to be a buyer on the other end, that's willing to buy what you're trying to sell. And if you're trading a stock that has poor volume, there's a chance that there's not going to be any buyers.
Exactly.
So when you try to get out of your position, you might end up stuck in it.
Yeah, and then as far as speaking about the uptrending stocks, a good indication that that potentially could start uptrending is you want to look at the two most simple indicators that we look at. They're the RSI and the MACD indicator. They're going to tell you if it's overbought, oversold. Once again, we'll make future videos explaining how each of those indicators work, but looking at it from a very simplistic standpoint, you want to make sure that where the RSI is red, as you can see,
which this is the RSI right here.
The top one's the RSI. Where that's red, that's going to be telling you that it's overbought. So ask yourself, that's not a good buy. You wouldn't want to buy it there at its peak. You want to buy low, sell high.
Right.
Same thing with the MACD. That's just another way of showing you where the direction of the stock is going, if it's overbought, oversold.
So you want that MACD, which this is the MACD down here. This one doesn't look fantastic, but it doesn't look bad. You want it to be, basically you want to see it starting to curve up. You want it to, after a long, how it would have been right here, how it's, down, 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 down. You want to catch it when it's starting to curve and point back upwards, because that is determining the future price of that stock.
Yeah, like Apple, this is AAPL's Apple. So it has earnings November 1st. This is why you see it, it's zigzagging. It's consolidating because people are, betting on the earnings. They don't know if it's going to beat earnings or miss earnings. That's another thing. You don't want to hold, personally, and I think Cole agrees.
Yeah, I would agree.
You don't want to hold a stock through earnings, because if they hit, if they pass earnings, they do really well, most likely you will make money. But if they don't, you're going to be sitting there, and after market, you're going to see that thing take a real big hit.
And there's no way for you to be able to know. It's more of a gamble than anything, and we like to focus on basically, making the best trades that we can possibly make. We like to manage risk. We'll get into managing risk in a second here, but it's the same thing. So with the ETFs that we trade in the commodities, if you trade something, there's a natural gas report that's reported every Thursday at 10:30, and it basically
it's almost like an earnings for
it's almost like earnings for natural gas, and it's like I don't like to hold UGAS or DGAS, which are the natural gas ETFs, through that report, because it's a gamble. You never know what it's going to be before, and it's the same thing with earning calls with normal stocks and normal companies. You would never know unless you are inside trading, which is illegal.
Yeah,
so
you can do your own due diligence and really look at the company, look at past earnings,
right?
Look at other company, like its competitors, see how they're doing, their earnings. But sometimes in the earnings call, they'll beat earnings, and then say management takes a step down, and they'll beat earnings, and their stock will go down because, say, a CEO decided to step down, or they don't predict that the earnings are going to be as well in the future, and then so it's just
it's more of a gamble than
gamble
we would prefer, because we like to manage risk as effectively as possible, which is really important when it comes to trading stock.
So speaking about managing risk, we like a 5 5% gain to a 1% loss ratio. So when we're looking for stocks, we want to see drawing support and resistance, looking at the indicators. We want to see if it will offer a 5% gain to a 1% potential for loss. And we're going to set our stop losses, which you can do on Robinhood, which is the platform that we like to use. It's very simple. You set it stop loss order, and you don't have to sit there and hawk it. You don't have to be like, oh, it just broke below my support, and then you have to sell it. It'll sell it automatically. It's easy. Go over was the pattern day trade rule, which is any platform that you trade on, it's going to have that rule. It's made by the SEC, and what it is, it doesn't let you trade over 3-day trades a week. So if you trade 4, it'll like lock you out of your account. You have to go through a whole process. It's just not good. Like, you don't want to get there. And with Robinhood, it allows you every time you make a day trade. So we really want to cater to that. So if you could utilize your 3-day trades a week, or that's why swing trading, like what we were talking about, is actually, it's like a great thing, swing trading, because you don't have to
use a day trade.
Yeah, use a day trade.
So a day trade is just a trade that you buy and sell within the same day. Say I buy I buy you guys on Thursday and I sell it that same Thursday. That would be considered a day trade, and you only get 3 of them within a 5-day period.
Yeah. So going off of that, if you are at that limit, so if you are at your 3rd day trade for the week, we recommend you're done. Don't trade. Don't even swing trade a stock. Even though you're not going to get hit with the day trade, don't swing trade another stock, because say you're holding that stock and you're already at your 3rd day trade, say something happens, right? Something happens overnight, or even midday, something happens, and you're like, oh, I need to get rid of that, So
you need to get out of the position and cut your losses short, which goes into managing risk.
That's what I'm saying. You're not going to be able to do that. You're going to be sitting there watching the value of your portfolio going down, and there's nothing you can do about it. So when you get to that 3rd day trade, just make a mental note. You're done for the week. You're not swing trading anything.
Yeah, you're done until you have, or at least you should be done. I mean, just because, like I said, it goes into managing risk. You should be done until you have another day trade open, so that when you do enter a position, if you do need to get out and cut losses, which also goes into managing risk, you wouldn't be able to do so if you already had 3-day trades used up. So you want to make sure that you always have at least one free.
Yeah, and then another thing, it's not really risk, but when you're trading, you really don't want to let your mind, you just stick to what you know. Don't let your mind play tricks on you. Don't
trade without emotion, because emotion, you can't trade stock if you're going to be emotionally wrapped up in what you're trading, because what tends to happen is somebody say you identify 5% potential for profit, and how we said if you, for every 5% potential for profit that you can identify, you should give yourself a 1% margin for loss, and if it goes under that 1% margin, you should cut losses right there, because obviously the trade isn't going your way. And what tends to happen is that people get emotionally invested in what they think is going to happen to a stock, and then when it doesn't happen the way that they imagined it or planned it out to happen, they tend to what's called bag holding, which is when you just don't sell and you just hold the stock, and just hope someday I'm going to get that value back. You don't want to do that.
Yeah, if you've been trading for a while, everybody's been there. Like, I've bag, he's bag held, I've bag held. It's not fun. You're sitting there down a good amount on your portfolio, and like, the stock most likely will recover or give you a little bit of that margin that you lost back. But you really have to be disciplined. If it breaks pattern that you have identified, you should just
sell it. Because then also you have to think about, time is a valuable asset too. So if
it's
you
opportunity
have,
cost.
If you have, it's opportunity cost. If you have money wrapped up in a stock that you're bag holding, that you don't know when you're going to see the value back, when you're going to break even and be able to sell out of that position without selling for a loss, you could be missing out on 5 great trades that would have made you, say, 20% in the meantime, when you've just been holding this stock the entire time just to break even. So it's a lot easier to cut losses at 1% and just take that 1% loss and get back into a new trade, a better trade with a new plan, and make yourself 5%. So then you're still up 4%.
Exactly. And then I promise this is the last thing. Like, you never want to chase a stock. Like, never get caught just chasing stocks. Like, a lot of people will be like, hey, this IPO of X, whatever stock is coming out tomorrow. Like, you really hop on it, right? Like, look at every IPO. I guarantee you, it's just a pump and dump. People
Exactly.
get in it, it goes up 30%, and then boom, it goes down within the day. It'll
Yeah.
go down.
We
to
would
like,
highly recommend that you all stay away from IPOs. Those are not for novice traders. They're not even for individual traders, really. IPOs are for Wall
Yeah,
Street.
you want-
for Wall Street to make their
it
money.
is, yeah. You want to trade stocks that have been around for a little bit, that enough that you can go back
That
and
have
see the
history.
history of it.
Exactly.
So, yeah, that's pretty much it for today. I mean, unless if you have anything else that you got to say.
No, I think that's it. I mean, everything that we went over in this video, like I said, was just an overview, just to give you a little bit of a better idea about how we go about trading our stock. We're going to get, much more into detail in the future in upcoming videos, and everything that we talked about in this video, we're going to break them, all of those, each individual things like RSI, MACD, support, resistance, candlesticks, time frames, all of that into little 5 to 10 minute videos, so it's much easier for you to get in there, watch a short video, 5 to 10. This is a little long for what we're normally going to be posting.
Like we said, the videos that we post are going to be 5 to 10 minutes long.
Right.
There's just a lot of content, but every single thing that we said in here, there's going to be a video for that. We're also going to upload videos of us breaking down stocks, so you can get into see how we do it, see how we go about it, and like use what you like. If you some things that you don't agree with that we do, then
right, you
just,
take what you like. I mean,
yeah.
Our wisdom is our wisdom. Yours is going to be yours. But we just want to put our wisdom out there for people to utilize if they like how we trade. But like we said, there's going to be videos in the future that are going to break down each of these individual things in more depth. In shorter videos, 5 to 10 minutes. 5 to 10 minutes is a little long for us. But I think that's going to do it for today.
Yeah, that's it. And as always, the Twitter, Instagram, Discord, it's all going to be in the description. Yep. Feel free to join the community. Follow us on Twitter and the Instagram, as I said, and
stay updated with all this. And we'll see you in the next one.
All right, thanks, guys.